brand new feature in the portfolio calculator, as well as a consolidated data update. I'm going to explain that. So this brand new feature we've talked about before is the CVIX indicator. You see the CVIX threshold and CVIX. If you want to turn on the CVIX filter, you add a 1 here. If it's 0, it will calculate the way it has been calculating. If you want to use a filter so that it doesn't trade if the CVIX is greater than the CVIX threshold, then you put a 1 here. And you can also adjust the number in which it does not trade. So the higher this number, the more volatile the market is. And it's based on our CVIX Volatility Index indicator, day trader, Capstone VIX indicator. I'm going to show you that real quick, and then we're going to come back to the portfolio calculator. So if you're a current subscriber, I'm going to be sending this out to you today so you can reference the CVIX indicator. Today, it is only at 7. And this is the number of zigzags of 1/3 of 1%. You can change that number. We're using the close of data 2, which is NDX, which is the cash NASDAQ value divided by 300. So 1/3 of 1% is the number, and 7 of those today. We've seen high numbers. Yesterday was fairly high, 17. We've seen as high as 70 plus 75 or so. Back on January the 24th, we divide that by the VIX to get the standard CVIX number, and if it's less than 1, it's kind of in that normal range, and if it's above 1, volatility is creeping higher. So that is where we get that number. And once again, if you're a subscriber, portfolio subscriber, you are going to get this indicator sent to you, so you have access to that. And you can see, if you use the CVIX filter, you can see whether you should turn the strategy on or off the next day. So basically, if you decide to use this CVIX indicator, it's brand new, and the data could change, and the way we calculate this could change, so it's brand new. We're using the VIX, and so it's a new approach, and so it's a scenario where it's kind of in a test mode right now. But if you do decide to not trade if CVIX is greater than 1, what you would do is you set that to 1, and then you can come down here in the daily P&L, and it exports that. We export it to the CVIX indicator to this column, and if CVIX is greater than 1, in that case, then we don't trade the next day. So you could get several days where you don't trade. In this case, CVIX went greater than 1 on January the 21st, which means you would not have traded on any days until the CVIX indicator dropped. So it dropped there, and you would have ended up trading on February the 1st, and then on February the 1st it was above 1. So it went above 1 again, so you wouldn't trade again until it dropped below 1. So then you'd trade again on February the 8th, and then it went above 1 again, and so you don't trade here, but then you start trading again here. So that is how you would interpret that, and you can just take the day off if you have a high volatility. Sometimes high volatility can be difficult to trade. You can get more platform crashes. The market moves faster. Automation is more difficult. And so let's look at the results if we do. So our main focus is the stock index portfolio 40. And another change I've done is I've only gone back to 2008 on the data. The data is not relevant, in my opinion, prior to 2008. Most futures markets did not trade electronically completely until about 2008. A lot of the CME futures started transitioning at the end of mid to the end of 2006, and then a lot of the ICE markets did not transition until 2008. Even the S&P started in 1997, so the session differences and volatility differences have changed since then. And so relevant as far as index values and relevancy, 2008 forward, more relevance in mid-2016 forward, and even more relevance in 2018, and then again in 2020. Those are different stages of relevancy, in my opinion, based on this. So we want to make our spreadsheet not so big that it's hard to use. Also, I got rid of the weekend date. So you see here 1-4 jumps to 1-7. We don't have 1-5 and 1-6 on here. I did that because I anticipated potentially putting Bitcoin or cryptocurrency data in there which trades 7 days a week, but that is, I don't anticipate doing that anytime soon. So this is just for futures, and we're just focused on Monday through Friday futures. We've been able to make this workbook smaller, focusing on Monday through Friday and just going back to 2008, because I want to add some more filters in here potentially, more CVIX filters. This is just on the NASDAQ. So for the stock index portfolio, it's pretty applicable, but if you apply it to all markets and some of these other portfolios that are listed here, it may not be as applicable because we're just focused on the NASDAQ. And so gold or crude oil, all those markets right now are volatile, but gold and crude oil could have their own CVIX indicator. We could have a CVIX indicator for each market potentially. It does make it harder to implement, just trading, managing market by market versus all markets on or all markets off. And so right now we're focused on stock indexes. I may also add FOMC calendars on here and some other filters some of my subscribers have suggested and shown me that they like and have recommended to add. So if you have a filter you want to add, let me know. This is the latest portfolio through February the 16th. And so the way you do this is you look at these worst case drawdown, 74, 840, 750. Let's go down and look at that. Now, like I said, the data is most relevant from around mid 2016 forward with about a 50K drawdown per E-mini or 5K drawdown per micro. And so if you go back here, prior to that, it's less relevant. The point values are different. Some of the strategies that we're trading now don't work as well back then. The ranges aren't really big enough for some of the strategies that we have now. And so let's look at the CVIX. If we add the CVIX, if we say, okay, if the CVIX, if it's too volatile, the market gets volatile, and the CVIX is greater than 1, let's not trade. So the current drawdown is smaller. It's 7K instead of 23K. And keep in mind, this is based on an E-mini. Divide by 10 per micro. So this is 5,700 per micro. And going back to 1997, that was 92K. And so if we come down here and you see a bigger drawdown right here in 2018. So your drawdown is actually bigger in 2018. Your total profit over a drawdown is higher because the max drawdown going back to 2008 is lower. Your max this number would be larger if you just measured it back to mid 2016 without the CVIX, but if you go back the entire time to 2008, it's higher here. I've looked at different values here. You could really limit your thinking here and say, wow, if you don't want to go above 0.6, it means you'd spend a lot of time not trading the markets. And so what does that look like on the drawdown curve? Much less trading. Your total net profits go down quite a bit. Some of these are almost cut in half on your total net profit. This is lower, but if volatility makes you nervous, if you want to trade less, if you want to have scheduled time off, you can't really schedule it. It's kind of like, okay, volatility's high, I'll take tomorrow off and I'll start again when volatility is low. It could be a month, it could be a day. You can't predict the future, but if you just want to, if you don't want to trade every day, you could use something like this and say, I want to sacrifice these profits because I don't want to trade during high volatility. So you could test different values. What about 0.8, 31.64, 52? Looks pretty good actually. So this looks pretty good. This number is right at 50K where it was before without the CVIX. So this might be the best number to use. 0.8. This number is around 3,100. So if you put it at 1, this number is 3,100 and that number is 57. So 0.8 might be a better number to use on the threshold. So you say if the CVIX is greater than 0.8, then I'm just not going to trade. And so how does that look on your total net profit? Let's take a look at that. So your total net profits are 262, 175, 434, 367, and 59K. Not bad. And it would be up on the month, up on the year. Let's look at it. Let's expand this and look at it without the CVIX filter. So without the CVIX filter, trading it as it is, 382, 252, 556, 445, plus 35K, down a little on the month through February the 16th. So higher net profit, you know, less volatile. You're trading less. If you add the CVIX indicator, you're trading more. If not, so really depends on your personality. Adding more rules sometimes is, you know, it's new, so you have to consider the fact that it's new and it's a new rule. And so, but it looks really good overall, and I want to make this available to you in the latest portfolio calculator. Keep in mind, the data now only goes back to 2008, and we also have eliminated the weekend, so the workbook is much smaller, and instead of going down to about 8,000 rows, this goes down to less than, it's only at 3688. This was going down to over 8,000 rows, so we cut the data in half by removing weekends and the data going back from December 31st, 2007 to 1997. We had November 1997 in here. So over half the data is gone. It's a more efficient workbook to work with now, and will allow us to more easily add additional rules here without bogging this down to making it so slow it's not usable. So wanted to share that with you. It's on the website now. I want to show you where you can get this. Go to CapstoneTradingSystems.com and you go to the calculator and you'll see it right here. Download this Excel spreadsheet through February the 16th, 2022. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.